And these are ones that could lend a pretty significant opportunity. And I think you find more of your value investors looking at companies in both of those in categories 2 and 4 here, where we're talking about slow growth and turnaround stories. Welcome back in YouTube. So today we're just going to get right into it. No intro, no nothing. Do not want to waste your time. And also, I'm sure you guys realize I'm not posting as much. That's because I'm closing in on a house and I will be sharing that house with you when I get a chance. But I probably won't be posting as much as I normally am. And I know I've been giving you guys the warning, but life is getting busy. I'm starting up a new business. I'm buying a house. So I still want to do YouTube. So guys, make sure you like and subscribe and keep me motivated to keep posting for you. If you find value. If you don't, totally understand. But today we're going to talk about 4 different types of stocks you can basically own in the market. Regardless of what the market's doing, whether we're going into a recession or not, there's really only 4 different types of stocks we can own. And I'm going to talk about how we need to break this down. Now, obviously, I didn't create this. This is actually a Peter Lynch theory that I tend to agree with. And on top of that, I'm going to give you guys a visualization of exactly how I break down these 4 types of stocks. Now, as always, guys, this is not financial advice, and I always recommend the majority of your portfolio should be in a diversified index. So let's get into it. So if I were to draw basically a bell curve here and break it down into 4 sections. Now, the first section would be obviously your rapid growth stocks, your fast growers, your high growers, whatever you want to label this. A lot of times you're going to get these high-end IPOs, companies that are growing over 25% in the foreseeable future. And when we talk about companies that have IPO'd, if you wait a few years, it's usually a better opportunity to get in later on the IPOs because there's a lot of things that happen during an IPO. Companies are raising capital, so they're selling into you. They're maximizing how much money they can make into the market and raising capital for the company. So there's things here that take place during initial IPOs in the first couple of years that could really cause that could really cause you to overpay for an individual stock. And over the last few years, guys, we can talk about a ton of them. And 70% of the time, you can get these cheaper. It's very, very rare that you're getting a good deal on an IPO. Now, I can talk about Coinbase that came crashing down, has traded in the 30s. And I just want you to think about buying a $400 stock and seeing it in the high 30s or the low 40s. Pretty scary to see your investment do that. But what are you paying for? You're paying for the hype, you're paying for the growth, and sometimes that growth lets you down. We obviously know about SoFi. That was another high flyer that you could have waited and got it much cheaper, going from 13 down to $4. Palantir, another one that you could have waited and got it much cheaper. Now, obviously, some of these are recovering now, but they're still not even at their original IPO level. And all these were considered to be your high growth type of stocks. And so things you want to look for here and what failed with these companies, guys. Why did they not keep going up in price? Why did they not keep going higher and higher? There's 2 things you want to look for in a growth stock. Number 1 is you want to see them growing top line revenue, which I think for the majority, all of these have done. The next thing is you want to see them rapidly growing EPS. That is a question mark for a lot of these companies. Most of them were unprofitable, right? That was a big thing. So if they're unprofitable, their EPS is not growing in a positive direction for the most part. So you want to see rapid growth on top line, and you want to see that rapid growth on top line follow through on earnings per share. The other thing is you want to make sure they're not diluting too much and they're not taking on toxic debt. So all these things have to be going right in the early stages for you to really justify overpaying for a stock. When you could wait for it for a few years to come down, now Peter Lynch calls it innings, basically relating it to a baseball game. Wait a few innings and see if these things actually come back down to life or if they're still maintaining their growth. Take a step back, don't get emotional. And he talks about 2 different stocks here. He talks about Walmart and he talks about Microsoft, companies you could have waited on during their IPOs and still made 20x your money. But what are you doing? You're getting confirmation that they're doing the right things and that they're still going to stay in this fast growth or hyper growth mode. A lot of times it might be 1 or 2 years that they're in hyper growth and then they just hit a massive wall here. And this is the next area we're going to talk about, the second wall. So the second wall is going to be slow growers. We'll put an SG here for slow growers. What is the key with buying slow growers? Well, if they're only growing revenue between 5 and 15% is basically where Peter Lynch talks about these being slow growers. 5 to 15%, I think most of us would actually be pretty happy if we found a slow grower that's growing consistently 15% top line revenue growth in EPS. Okay, so when we're talking about growth, we're talking about top line revenue and earnings per share. So with the slow grower, what do we need to know or what do we need to understand about a slow grower? There's one thing you have to do with a slow grower. You have to buy it at a good price. That's the only thing that makes sense with the slow grower. And so what are we seeing right now? We're actually seeing if we minus out the big tech companies that have had very bullish moves recently, there's a lot of slow growers here in this sector in the 5 to 15% revenue growth that are actually trading at reasonable valuations and at what I would consider to be fairly cheap. And so I do think right now is an interesting time to be looking at these slow growers. Now, a lot of these slow growers are not going to be sexy names, but I do think getting them at the reasonable prices and basically trading at forward PEs in the single digits, and they're paying substantial dividends, and they might be even dividend growers, but they're still, the more important thing besides the dividend and the dividend growth is that the top line revenue and EPS is following, and their balance sheet is actually getting stronger. They're adding cash on their balance sheet. They're not diluting. Maybe they're even buying back shares, which means that EPS is going to grow even faster. So these slow growers are tending to be an opportunity that I'm seeing here. And so one of the slow growers that I really like is going to be CVS. There's a lot of reasons why I like CVS. I think it has the wrong multiple on the stock. I think CVS is trading for a single-digit forward PE ratio because it's lumped in with retail like Walgreens, and it is more than that, guys. When I look at a company like CVS, it isn't a slow grower. I think it's going to grow between, basically 4 to 6% revenue growth, which kind of falls in the slow growth area. But why do I like CVS so much? Is because I think the multiple on the stock is mispriced. It is getting lumped in with retail companies like Walgreens, but only 50% of their business is really on that side. What is the other thing that's been taking place? Have you guys been following these weight loss drugs that are going out? Who's going to win that race? There's a lot of companies that have advantages. There could be some more weight loss drugs coming, but who's going to benefit from these weight loss drugs being prescribed? A company like CVS is going to be benefiting from this massive rise in weight loss drug interest, right? Everybody's going to get prescriptions and they're going to go to Walgreens. You're going to go to CVS for that prescriptions, and that's going to boost up their retail side. But what other side of the business are we talking about here? Their healthcare side is absolutely growing here. So another 50% of their business is also healthcare, owning Aetna and now getting involved in home healthcare and long-term care. So they own Aetna as well. And so they have the healthcare side along with retail, but their multiple is saying that they only own retail. Trading at a forward single-digit PE ratio is telling the street and is telling investors that basically this is just a retail company. And even if it doesn't get this priced in the next few years, which I do think price discovery is going to happen on this company, and I think it's going to happen quick. Even if it just prices in the retail side here and trades at a single digit to maybe a 10 forward PE ratio and still grows their top line revenue at 4 to 5%, I still think you're getting a good deal. Now what happens is if it unlocks this, I think stock price could absolutely skyrocket. Now this is a little bit more speculation on my side, but even if I take this out of the equation, I tend to think CVS is still a really, really good deal right now. So what is the third category of a stock? I basically lump 3 and 4 together. To me, they're kind of similar here. So you have 1 being hyper growth or fast growth, 2 being a slow growth stock, 3 is going to be a cyclical stock, and a cyclical stock is really going to be based off of economic activity that's taking place. With cyclical stocks could be very dangerous. They're very volatile type of stocks here, and it depends on what the economy is doing. Sometimes you need a strong economic backdrop, or sometimes you need something economically to take place for the cyclical to outperform the overall market. So when we think of cyclical, I don't want to just throw it all in one category here, but I think about hotels, food chains, airlines. Things that are actually doing pretty well right now, the cyclical business is actually holding up pretty strong here. We saw how depressed hotel chains become. Airlines were extremely, extremely cheap, and then they skyrocketed. And you see the volatility within the cyclical companies here if you just follow even those 2 or 3 industries alone. You have to have some sort of knowledge about the consumer to really speculate on cyclical. But I do think a small part of people's portfolios should be buying depressed cyclicals, because when they rebound back, they tend to have pretty substantial moves in the market. For most times, they're going to underperform overall indexes, but when they perform well, or when the consumer becomes very strong and shows resilience as they have been, they are going to outperform the markets. And looking at companies like Carnival Cruise Line, which I've done a video on, going down to, I think it was $6 to $7 a share, now trading close to $20 a share, is a huge move. Absolutely a huge move. And so this is a company that was kind of dangerous to invest in. The balance sheet was ugly. And then what ended up happening was the consumers showing some resiliency, they're turning things around, and the stock price is getting rewarded for that. Now we go to the fourth one, and this is the one, when I look at what's going on right now, I tend to think that the slow growers and the fourth area is pretty interesting, and this is going to be the turnaround. These are companies that are completely beaten up here. Prices are depressed, things are happening, and maybe you're looking at them and you're not making sense to why the price is so depressed. And these are the ones you really want to look at. And these are ones that could lend a pretty significant opportunity. And I think you find more of your value investors looking at companies in both of those, in categories 2 and 4 here, where we're talking about slow growth and turnaround stories. More of your value investors stay away from the high growth type names, unless if there is some sort of price disconnect that takes place. And so a few names that come up to me, or a few names that I think about when I see this, we talked about them before. I think Under Armour is going to be one that kind of comes to mind for me. This was a stock over $20 a share, is now trading between $5 and $6 a share. And when I look at their balance sheet and I compare them to other retail companies, I tend to think their balance sheet is actually fairly strong overall. I wouldn't say it's perfect, but I would say for retailers, it is pretty strong here. So now the question becomes, what is the turnaround story? What can Under Armour do to turn earnings back around? Because earnings will follow and stock price will follow earnings. So if they can turn their balance sheet around and they can get their earnings back on track and they can get the revenue growth back on track, I tend to think that this one is one that is a turnaround story. Stock price is depressed, earnings are going the wrong way, everything seems to be going wrong. But when you look at the balance sheet, it's really not that bad. They're not diluting. Earnings are kind of just been very stagnant. Top line revenue has been very stagnant. But is there a story here that can turn around the stock? And I think that there is. I think that when we look at what has happened through the pandemic, when we look at what has happened to retailers, a lot of retailers, you can use Bed Bath & Beyond as an example, a company going under. And then when you look at a lot of other retailers, they're taking on a lot of toxic debt. And so some of these retailers have to make it out. And when they do, and the consumer is strong, there's going to be limited places for them to go. And I think Under Armour is one of those areas where it has an interesting following, to where even if we go into a recession, the brand has a lot of sportswear, which is seasonal. Kids go play sports. Parents are not going to say no to that. So I do think there's a defensiveness built into here. And when the consumer gets stronger, obviously, I think we can see that turnaround story. So I do think there's some defense here. I think there's a good balance sheet story here. And I tend to think that this could be a turnaround story. Another turnaround story that is pretty obvious that I've talked about on the channel is going to be AT&T. What is the turnaround story here? This is a free cash flow story. This is a company that slashed its dividend as I projected on the channel, but it's now in an interesting situation where the price has been completely hammered down. They still pay a pretty significant dividend. Their cash flow story here is pretty interesting because the company is still guiding for $16 billion in free cash flow. And that, for the valuation on this company, is a lot of free cash flow. The company's trading at roughly $110 billion, which means that it's trading for less than 10 times free cash flow. And then when you factor in a lot of 5G infrastructure taking place here that I think AT&T can capture a lot of business on still, I still think there's an opportunity for top line revenue growth. I also think there's an opportunity to take this free cash flow, not only keep their dividend intact, but pay down that debt that they have. And when they pay down that debt, it's going to have multiple headwinds of growing the free cash flow. So as they take this free cash flow and pay down high interest debt, because they do have a lot of debt, and that is the one knock I had on the company. If they can really, if management is successful at achieving this free cash flow and they get their debt under control, that is going to grow both margins and free cash flow even more, which is going to have a strong compounding effect, which over the next 5 to 6 years should show great stock appreciation in the company. So now this comes down to, do you believe management? Do you believe they can execute? And do you believe that there's opportunity for them to still grow top line? And I tend to think that the answer is somewhere in the middle of a slight yes to all of them. They don't have to hit home runs here. The price is so depressed that I think the turnaround story is already in motion. It comes down to how well can they execute. So guys, those are the 4 stocks that I want to go over here. So just to kind of reiterate, we have the fast hypergrowth, we have the slow growers, have the cyclicals, and we have the turnaround story. So anytime you're looking at a stock, think about these few things. What kind of stock are you buying? And how do you evaluate this stock? Slow growth, fast. When we talk about slow growth, hypergrowth, cyclicals, and turnaround stories, is there assets within their business model being overlooked? So some of these slow growers, as I stated before, I think there's assets being overlooked. When I look at CVS, I think their healthcare business is getting completely dismissed and they're only being looked at as a retail company. So I do think that these assets are not adding up, and I think that's mispriced in the market. And so that's an area I'm looking at. Maybe some of you believe for these hyper growth stocks that some of the technology here are assets that are being overlooked, and that could add more value to the company than that's being displayed in the recent sell-offs on some of your high flyers. Same thing with the turnaround story on like an AT&T. They had assets like Warner Brothers Discovery that they spun off, got rid of them, got their debt down, and now they're working on one thing and one thing only. They're working on their free cash flow. If they can get this turned around, I tend to think that the stock is pretty cheap here. If they can't, then I think it's fairly priced. I don't think there's much more downside to this, as it hit about $14. And I think that's about as low as this stock can go, unless if they do something really, really stupid. So when I look at that, I definitely think there's a turnaround story for both Under Armour and AT&T, all in their own right. But then when we look at other assets that could be on the balance sheet, just something to consider when you're buying a stock. As always, guys, hopefully you enjoyed that, and we will see you in the next one. Peace.